I'm excited to be here. And I'm excited to talk to you guys today. I think it's going to be an amazing opportunity. I appreciate you taking time out of your day. As Ryan said, my name is Mike Fernicola. I'm with Unbridled Wealth. Today, what we're going to do is we're going to discover how you can incorporate the infinite banking concept, or IBC, to enhance your return on rental properties, fix and flips, and wholesale deals, all while creating a tax advantage for ever-growing asset to your portfolio. And so I think this is going to be huge for you guys as investors. And I think one key thing is it's important to learn the value of compound interest behind your investments, right? In order to set yourself up for the next downturn or the next real estate investment that you're purchasing. Somebody that everybody knows, Robert Kiyosaki, he says cash is king, but he also says savers are losers. And that's like super confusing jargon coming from the same guy, right? What he means by this is we need liquidity to purchase rental properties, investments, real estate, but maybe saving in the traditional banks that we do now might not be the best place to put our money and to store our money. And so today we're going to find out an awesome way to store money, to save money. And so whether you're a first-time real estate investor, joining the BRIA mentorship program, or finding great success in the market as we speak, you're going to find great value today in learning about this concept from time to time.
That's awesome.
So I guess I'll start. Oh.
Yeah, let's get started. And I will also let you know, I am actually using some of Michael's techniques. We've actually spoke numerous times. So not only, am I excited because I'm not using all the techniques, but it does work. And that's why we actually had Michael come speak via Zoom, obviously on the webinar, because it's, again, what Ryan says, what you don't know is what you don't know. And then as soon as you know, and even before we even got on, I said, I wish I would have known this 10 or 15 years earlier, but now I know. So you got to put yourself into action.
Yeah, it's true. And so, like they said, my name is Mike Fernicola. I am a husband, a father, an investor, and an educator. And before I jump in, I just wanted to show you my pride and joy. This is me and my family. Can you see my screen, guys?
Yeah.
Yep.
Yeah. Yeah, so this is me, my wife, and my two girls, Harley and Addison. I grew up with all boys, so I had to learn what it was like to deal with girls and women, and it was an unknown place. But I absolutely love my family, and I love being with them. They're fantastic, and that's why I do what I do.
That was a very nice way to say that. That was very, in case your wife's listening in.
Yeah.
Just one married guy to another.
You got to throw that out there right off the bat. But before Unbridled Wealth, I was an educator for children. I created custom plans for children. I created curriculums for children to experience exercise in a more fun and meaningful way. Now I create custom plans for people to have a more meaningful life and achieve their financial goals more efficiently, more effectively, and have a better end result. How I got connected to BRIA is my love for real estate. I think real estate investing is one of the best ways to create assets for your portfolio, to create assets for the future, and to create gains, right? And become financially independent. And so with that, I also do private money lending, and I've been doing private money lending for about 5 years now. I learned through that how I could get my money to work for me. Right? The ability to capture interest on capital is super, super important. And getting money to work for you is what we all want. With that said, I got introduced to IBC probably about 3 or 4 years ago, and a light bulb went off, right? And it completely made sense. We dissected it for a while as a family. We wanted to find the ins and outs and make sure that this was the ideal strategy for us. And what we found was the long-term wealth benefits of it was unprecedented. It was unbelievable. And so it helped us generate long-term wealth. And it also showed us a few different things as well, like multitasking dollars, having your dollars work in 2 places at once, right? This is something new, and it's something that can be done. It gave us peace of mind, but not only having this umbrella covering, but also peace of mind knowing that our money is not going to fluctuate with market validity. Right? Going up and down with the market, you're creating compound interest, but it's interrupted compounding. It's not uninterrupted compounding. So today we're going to be talking about uninterrupted compound interest. And then it also gave us what's most important for us as investors is access and control. And I'm going to add flexibility in there as well, right? We need access, control of our money, and flexibility so that we can jump on the right opportunities in the real estate market, right? When a deal comes, we want to make sure that we have the ability to jump on that deal and create some wealth. So from creating custom plans for children to creating custom strategies for investors who want to achieve financial and long-term financial independence, part of my job is to educate, and the other part is to create strategies and to strategize with. So what is this? What is the strategy behind the infinite banking concept? And so I want to dissect this first. And the infinite banking concept is this concept of storing money in a safe place with guaranteed long-term returns, while also keeping that money liquid for emergencies, investments, and control. Before I jump into this, I want to get into some modern financial advice. And modern financial advice is going to be, paying off your mortgage, right? A lot of times they say, hey, pay off your mortgage, put more towards your mortgage. And we know as real estate investors that a lot of the foreclosures that we pick up, a lot of the people that we help while investing, I know during wholesaling and what Anish has been talking about in previous webinars is, you're saving people from losing their house by providing them with some assets, some money, right? But a lot of them have a ton of their mortgage already paid off. And so this might not be the best place to store your money, right? And in a downturned market, your equity in your house is not worth what it was that previous year. And so you try and get a HELOC or a cash out refi, and you're not going to get everything out of what you had at one point. And so it's fluctuating and you have no control over that. And so our goal today is to see if we can find the ideal vehicle with the most control. Some other advice would be put it into your 401k, IRA, and these are all great, but these are long-term plays without access, right? You can't touch it till 59 and a half. And when you do, you're penalized, there's fees, there's certain things that come out. The best of these vehicles is that self-directed Roth that Anish has talked about in the past. And this is a phenomenal tool to capture interest on a property. It's amazing, but it's also limited. And so the limitations are 6,000 you can put in per year. So it takes a while to grow, right? Also, if you make above 210,000 as a couple, you can't put into a Roth anymore. And so our goal is to kind of continue to generate wealth. And if we hit certain peaks and certain points, we can't put into these vehicles. Some things when you direct it to real estate, you can't live in it. You can't work on the house, right? You can't use outside money. And so with these limitations, this is a phenomenal vehicle still, but they can cause taxable event, which negates the purpose of the Roth. And so our goal is to find something that is flexible, that can come besides a Roth, that can come besides what we're doing already and become an and asset. And that's what we get when we implement IBC, right? The IBC strategy puts you in control of your money and allows you to take your finances to the next level. And so we're going to jump into some slides real fast. Let me just pull this up. Let me see.
Almost.
There we go.
There we go.
Got it?
Perfect.
Am I up?
Yep.
All right, beautiful.
Yep, good.
All right, so before we begin, this information is provided as not written or legal advice. I'm not an accountant or CPA, and so for that, go to your legal counsel. But I wanted to start out, and I'm excited to introduce you to somebody called the Generous Banker, right? I'm going to do this by introducing you through the story of the tale of two bankers. Now, we know this first banker, and this is the typical bank in America. This person is super generous, right? They give us a 0.01% on our money, and then they tax us as income on that money. So they're great. We know this bank when we enter into this bank, we go to write a deposit slip and give them money. And we utilize that pen that's on the desk that's chained down, where you can't even walk 3 feet without ripping it from the desk, right? They don't want you to walk away with that merchandise. And so we all know this bank, we all love this bank, and this is what we all use. But what if I told you that there was a banker, the Generous Banker, who can give you a 4% return on your money, who says, man, we're not even going to take taxes out of this. And this could be tax-free growth for the rest of your life. Man, which bank would you choose? Would you choose the generous banker, or would you choose the typical bank in America? I mean, keep doing what we're doing or find a different avenue. But what if I told you
I'm going to go for the generous banker, Michael.
Yeah, you know what?
The audience will, I'm gonna go out on a limb and say, is that a trick question, right? Because I don't think any of the bankers are generous. But
it's so true. This is a trick question, and we're gonna dive into that. And so, what if the generous banker also lets you borrow other people's money, just like the bank, so that your money can earn 4% while you use it? What if the banker also provides protection in case of a lawsuit so that they can't see your assets? What if the banker also provides a death benefit in case something happens to you so your family's taken care of? This sounds too good to be true, right? But what if all it took to have this bank was learning that what we have been told might not be what is best, and that what we have to do is just change the direction of the flow of money? Could you imagine yourself never asking a lender for another loan again? Could you imagine making more in interest than what you pay in interest? What if you chose the structure of the loans, right? Don't you want to meet this generous banker? If you want to meet this generous banker, type yes in the box in the chat right now. I'd love to see some yeses go through, even though I can't see. So Anish, you're going to have to tell me if they're typing.
All right, so
Pretty sure.
A bunch of yeses.
Good, come on.
Thank goodness they're listening, right?
They're listening, they're here. Well, what if I told you that you already know this person? And I bet you probably like this person too. Maybe a little bit, maybe a lot, because this person is you. All right. You get to choose the loan for yourself, right? You get to be your own bank. You decide how you pay it back. You get more in interest than you pay in interest. Today, I'm going to show you how you can turn $50,000 into $600,000, how you can use your money for real estate, retirement, and increasing your ROI. This is long-term thinking though. So it's a strategy and a mindset change. It's not a get-rich-quick scheme, right? This, just like real estate, it's not a get-rich-quick overnight. It takes a long time requiring certain things, and three major things at that: patience, consistency, and financial responsibility. And these are all things that you need as real estate investors to make sure that you're patient for the right deals, right? You don't want to jump on every deal that comes to you. You want to make sure that you're getting the right deals. Consistency. How many times are you going to knock on the door, right? How many times are you going to go and call the person who needs help, right? Getting out of their house so that you can get a deal and that they can get a deal, right? And then financial responsibility. You don't want to overpay for something. And so you want to make sure that you're being financially responsible with how you're creating that deal and making that deal. And so what we're going to do is we're going to get into the saver and the wealth creator, right? The saver is what we need to save money, but then what do we do with that money, right? Because every decision comes with a cost. Even utilizing cash comes with a cost. And so as we save money, we save and we transfer away our wealth to pay for things. And then we start back for the next purchase, right? So we climb this ladder here as we're saving up. We buy that first property, and then we transfer away our wealth, and then we have to save again for that next property, right? And so we're consistently getting rid of our basis. But what if we can save? We can put $100,000, let's say, for that first property, but we never lose our basis. What if that money can grow for the rest of your life, right? And so what is your primary funding source? This just pops up as a poll question, right? Is it cash, qualified accounts, private money lending, hard money lending, or other? And so with that said, what is your money doing? If you put $100,000 into something like IBC, where it's going to grow at 4% for the rest of your life, that money would be $480,000 in 40 years, right? Not too shabby. But now you're thinking to yourself, well, but I bought 4 properties in the other by using my cash, right? But what if you could do the same thing and buy those same 4 properties, and each time you borrow against, and you fund your bank back up. You borrow against and put money back into your account. Every time you borrow against, your basis is higher, right? You have more money in your account, right? And so the only thing that's different here is that you're lost out on $480,000. So this strategy is save and continuously borrow against your money. The whole amount saved grows at that 4% plus dividends while you use it. So the decision to consistently work for your cash versus the decision to have your money consistently working for you comes with a cost.
Yep.
What were you
I
guys
was going to
saying?
just add, Michael, yeah, that, what you're doing is you're actually leveraging,
Mm,
right, your bank.
yeah,
The other good thing is, as you mentioned, as the banker, they're not doing a credit check on myself, right? If I'm the
right.
generous banker, I'm not worried about loan to value. There's some big
Yep.
things that benefits because I'm already doing this, and it is amazing how quick Ryan and I can move on deals. If the title work's already done, hey, if we really need to close tomorrow, I could actually close tomorrow. I don't have to go through my traditional hard money lenders, or if I'm trying conventional banks or whatever the other aspect of it, and it gives me a competitive edge
Right.
versus other
And it,
investors out.
yeah, and it acts as cash, right? It acts, you pull that out, you have it in 2 to 3 business days, and you have it ready for you. And then if it's through like an Ameris Bank, like we were talking about, you could write the check right there, right?
Yeah.
As a hard money loan, or not a hard money loan, but a loan against the cash value. So the basis of this never changes. And so you want to keep your money that you have earned, not transfer it away constantly. And so that's the point of this infinite banking right here. So how do we get this? And this is through an infinite banking contract. And what is it? This is a properly structured whole life insurance policy issued by a well-established mutual carrier. Anish, are you still there? Did everybody
Yep.
log off? Oh, okay. Oh, okay. Well, I
You're
said
still
whole
good.
life insurance. So, okay.
Everyone's like, I'm out of here. Thanks
Yeah,
for
I'm out of
nothing.
here. And, most people hear this and they have, it has a bad reputation, but this is a powerful tool for complete control when put in the hands of the generous banker, right? This gives the ability to fund deals, to have unstructured loans like we were just talking about. And if it's properly structured is what really makes a difference. And so what we're going to really get into here is the difference between typical whole life and then a properly structured whole life policy, right? Because that makes all the difference. And you can say what you want about whole life. A typical whole life, I would not recommend to 99% of people, right? But a properly structured whole life could work for investors in phenomenal ways.
Yeah,
And
Michael,
so,
what I noticed in general is even talking about the whole life
mm,
before I got educated, I thought that it was just one thing, right? It's like
right.
saying, oh, there's a retirement account, or there's just this, and there's buckets within it. So I
Yeah.
think it's always important when you're working with someone that is actually also you being an investor, so this space versus maybe someone else. I'm not going to pick on other life insurance agents, but maybe that, they're just selling insurance. So I think
Yeah.
that's really a big distinction.
Yeah, exactly. And, I became an agent, or I was a client before I was an agent, right? I was utilizing the strategy before I was like, wow, I need to share the strategy, because I found it to be an amazing strategy to help for future, right? To help for your future, to be able to pull from those buckets, like you were saying. And, I think like that's the biggest thing. I'm not here trying to sell insurance, but I'm here showing the value of utilizing this as an asset for your assets. So with that said, so whole life consists of a premium, cash value, and then a death benefit. All right. The cash value is what's really of importance here. That is the savings component of a whole life policy. All right. And so the premium is what we pay per year, and the death benefit is what we get from insurance. So in a typical whole life policy, we put in $10,000, let's say a year, right? You have $0 cash value that first year, but you have an $800,000 death benefit. Now that second year comes around, you put in another 10,000, your cash value would grow by about maybe $1,200. And these are hypothetical numbers. This is sort of it's not 100% accurate, but then you'd have a death benefit of about $810,000. Now, 18 years later, you would have put in 180,000 cumulatively. You would have $180,000 in cash value and $1 million death benefit. Now, it took 18 years to break even on this policy. And that's a long time as an investor to wait on your money to come through something, right? I know, like Nish was saying, we want liquidity. We need liquidity as investors. If a downturn comes and I don't have it, like, I'm sitting on nothing. And so that's what IBC is going to do. In a properly structured policy, we have this same premium, cash value, and death benefit. Excuse me. Let's say our premium's the same of $10,000, right? What we're going to do is we're going to then split that premium into two different things. It's going to go to base, which is 20%, or that $2,000 right there. All right. And then it's going to go to paid up additions, which is this $8,000 or 80%. So that 80% goes to cash value. The 20% is going to go to the death benefit. And so what we see year one of this first premium is $8,000 goes right into cash value, which can be used right day one. And then your death benefit is about $500,000. You bought less death benefit, but we don't need that right now. That's for the future. And that's not why we're doing this. We're using this as our banking tool. So that second year comes in and we spend $10,000. And what we see is that whole amount of premium goes into our policy. So we have about $18,000 in a cash value. And then we have a little bit more death benefit. So our death benefit's increasing, our cash value is increasing significantly. Now we're going to drop down to year 10. So not 18 anymore, but year 10. And year 10, we would have put in $100,000 cumulatively. We would have about $110,000, right? So you have a little bit more. And is that a huge investment? No, it's not a great return on your investment. But what this is if we're looking at this as our bank or our banking tool, your bank just gave you $10,000 for banking with them for 10 years. That's pretty good. My bank wouldn't do that. The typical bank in America wouldn't do that, right? But now what we're going to do is I'm going to show you the value of why we want to borrow against this, right? Because we saw the generous banker, he said, you can borrow other people's money so yours could keep growing. And so the value here is, let's take a loan against our policy at $100,000 loan. Let's say we're going to buy this beautiful house for $100,000. I don't know where that is, but I want it. At 3.5% interest. All right. That's the interest rate that we're getting right now. And then we're going to set how long we want that loan to be. So I'm going to say, I'm going to pay that back in 10 years. Okay. So I'm going to amortize 10 years. And so in that 10 years, I would have paid $18,663 in interest. Now you're probably thinking to yourself, why would I want to pay $18,000 in interest to use my own money? It doesn't make sense. But the reason why you do that is because you're paying simple interest on the loan and you're earning compound interest on the whole amount of money in your policy. So you have $110,000 growing at 4% interest, right? We're not even taking into account the dividends. So that first year of that loan being out, you would have earned $4,400 inside your policy. That second year, 4% of $114,400 is now $4,500 inside your policy. After 10 years, your money grew by $52,000 inside your policy. So you spent 18 on interest, or you had to pay 18 in interest, and you made 52 just in your bank, right? So you netted $34,000 while using other people's money for an investment. That's not even including the investment, whether that's appreciation, rental income, right? Whatever it may be, the percent that you made on your investment plus the 34,000. So your ROI is better. Your rate of return is better because you utilized a banking system that was adding value to your life.
And Michael, so I've just had a question on that, right? So
yeah,
what's important also, there's no loan to value, right? You could fund the full let's say the purchase price, same scenario, $100,000, it's a full 100 that you're writing versus your traditional lenders, right? I know some of you guys are on that poll. We're using private money lenders, and Michael's a private lender, so you're not lending 100%, right?
Right.
So as a private lender, I should say,
Yeah.
or a hard money lender, right? They want you to have skin in the game. There's no credit check, and so you're banking on yourself. So I think those are the other benefits besides the obvious, the $34,000 scenario. What you're actually getting is all these other things that usually stop you from doing other deals.
Correct. Yep. That's 100% correct. You can fund the whole deal through this. You can do a portion of the deal through this. They're not going to ask questions. You say, I need $100,000. They're not going to say, what do you need it for? Well, how long are we going to get it back? It's like, no, they say, okay, into your account, and 2 to 3 business days, it's getting in there. And so that's the biggest value add to investors is you can have your money right then and there.
Yeah. And actually, Daniel's got a question.
Yeah.
Does the whole life policy own the home?
No. So they owe you contractually an $850,000 death benefit if we're looking at this. And so what they do, since they already owe you money, they're going to collateralize that money that you're taking out with that death benefit that they already owe you. So if something happens and the house goes through whatever, if you pass away, they're going to take that $100,000 and say, okay, well, we're going to pay ourselves back through that death benefit, right? Because they already owe you. And so they don't own the home. They don't care what you're doing with the money. You can go buy a car. You can go on a vacation. You can do what you want with it. We're talking about investing today, but your investment is not owned by them. It's owned by you.
Yeah. I mean, again, it literally, you're writing the check into your account.
Correct.
So
it's your money.
Yeah, it's your money. So you could, as Michael's saying, you could do pretty much everything with it. We're saying don't use it for a vacation, right? We are talking about investing. So put it back into your investment career. Danielle's actually asking, is there an age limit for these policies?
Is there an age limit? No, you can start a juvenile policy, which is under, I believe it's 18, or age limit as far as how old you are.
Yeah, I think that's
you could start at 18, and then I believe it's 82. You can't do a policy anymore, I believe, and I could double check on that. But you want to see kind of based on health and age. As you get older, your health is declining a little bit. It's harder to get insured, and so the 20/80. So the 20% base and 80% PUA is going to be a lot harder to reach. And so because these things are based off of age, health, and then gender, it will be a lot harder to bank with it, but it is possible. But you could, let's say you're uninsurable or you're 80 years old and you wanted to do this, you can do it on a younger family member or a coworker or whatever it may be, somebody that you have you are connected with, and you can utilize the banking function of this with insuring somebody else. And so you can still do this. It just might not be insurance on you.
Yeah. And for me, not only am I doing it, my wife is too. So she's a little bit younger. Her policy's definitely cheaper.
Yeah.
She might be, in my world, she's a little bit more expensive otherwise, but at least her policy, I'm making some money back. Hopefully my wife's not listening in. Otherwise, it's gonna be a long conversation when I get home.
Yeah, you're gonna be in the doghouse. That's hilarious. Yeah. So I think the big takeaways from this is definitely you choose the amount of years that you want to amortize that loan. You could do a 100-year loan. You could do a 1-year loan. You could do a 4.5-year loan. They owe you, and so you choose how you pay that back. Yeah. And so what is the goal of IBC, and kind of why do we want to utilize this? And I think the big goal here is to never let go of your basis. I'm going to go back to this slide, right? We have we have our money inside of our accounts. We save money. We need to save money in order to purchase real estate properties. But are we letting go of our money that we've already saved, right? Do we just relinquish it to whoever, to the banks, to the mortgage broker, to who, we want to make sure that our money is working for us and for us forever. And so that's what this really does for us. And so we'll get into a few more quick questions if you have it, Anish.
Yeah, I got a couple here. Deborah's asking, do you have to wait 10 years to use your money?
No, you can use it day one. So that cash value that I showed earlier, you had 8,000 day one in cash value. You can use up to 95% of that day one, right? So the big thing is you use up to 95% of what's in cash value. But yeah, you have that day one access to it.
Yeah. And actually, I mean, we were kind of talking about this earlier. I know Michael's just doing a quick example for the $10,000. For me, that was a big concern of, I have a chunk of money. Ryan and I fund the deals here at Bria, so I need that money. What I did was, for people that may have, like, maybe they just sold their house, right? It's a hot market, they got a bunch of cash. And now they're saying, look, I want to put it into real estate investing. I need my cash. What would you say, let's say I sold that investment property, I paid the capital gains, all that other good stuff. I kept that money aside and I have $100,000 in cash. So would you, I know the answer, but the rhetorical question is, can I buy the insurance and put the full 100,000 and make those payments instead of year one, 10,000 a year for 10 years?
Yeah, you can do that. You can do a one lump sum. You can also do a larger chunk that first year and be able to pull up to probably about 80 to 90% of the money right out that day one. So you have liquidity. There is that cost of insurance that's probably going to be there for every plan that you make. And so with that, that first year, you're going to be in the red a little bit. And so you won't be able to take the whole amount out, but you would be able to take about up to 90% of that. And then you can continue to fund it, or you can stop funding it altogether and have it just kind of be this banking tool that you have.
Yeah. I mean, for me, that was a big, like, I've known about this concept for years and been doing it. And that was a big, well, I don't want to tie up my money. And then, when I really learned that, hey, I could do this, it kind of changes everything, my mindset. I was like, yeah, let me do this, and now I know you'll probably get into talk about overfunding insurance, but I do have a couple quick questions. So Daniel's asking, I used to sell term insurance and invest the difference. How would I convince a former client to now do this instead?
So, term insurance and investing the difference is good, but you're tying up your money into something else, right? And with that, we like to say buy a whole life and invest the cash value, because that's kind of, you have that liquid, right? This is an and asset. We don't want you to lose. It's not an or asset. It's not invest in whole life or invest outside, or, this is an and asset. So buy whole life, utilize it. If it's properly structured, you'll be able to use that for your investments. And so I think that's always a tough argument, but I think it's the availability of liquidity there, that you're able to still do your investments while you have the insurance coverage that's going to grow for you the rest of your life. Term insurance, 98 to 99% of term policies don't pay out. And so
can you actually, like, I know everyone's not an insurance nerd like we are, I should say.
Yeah.
Can you actually explain the difference, like what a term, or I go to work, right? I have a job and I have, they told me I have insurance. Like, what the difference in something like that in term versus what we're talking about?
Yeah, so a term policy is going to be for a specific amount of time. So if it's with work, it's for how long you are working at that specific place, right? So they'll cover you up to maybe $10,000, $20,000, $30,000 of coverage. If something happens to you while you're working in that place, they will pay a death benefit to the family. You can buy a term policy, which are super cheap, because the insurance company knows that that you probably won't, based on their statistical numbers, pass away in the amount of time that they're giving you term insurance for. And so that's what that's why 98 to 99% don't pay out. And so you're putting your money towards it. And is it super cheap? Yeah, but it adds up over time. And then when you try and get term after that, let's say you've got a 30-year time where you're insured, if you pass within that 30 years, they'll pay out that death benefit, whatever that may be, 100,000, 200,000, 300,000. They'll pay your family that. But if, let's say, you live and you're 30 years old, you have a 30-year term, you're 60 years old now your insurance is going to go up by a huge amount. You might be uninsurable, so you might not even be able to get insurance. And so, things are popping up all the time, like COVID, cancer, like all these things that create this uninsurability. And so as much as term policy could be used as a cheap alternative and to coverage for a time, it doesn't really last a while. And if you're looking to leave a legacy, if you're looking to kind of pass on or use this as a supplemental retirement tool, which we'll get into a little bit, term insurance isn't really going to be that beneficial for you.
And I can even speak from my own experience. My parents both had term. They outlived the term. So, yeah. And it's too late on that portion. Let's see, OV, can you prepay larger amount above premium to increase cash value faster? So can you prepay to increase cash value? So the
premium, in that last illustration, the premium, so the base is what the premium would be. So that 2,000 is pretty much the premium. And then you are overfunding the account with a paid up addition, or a flexible paid up addition it's called, and which is extra going into the account. So you can add a zero to that. You can add 2 zeros, you can take away a zero, right? So you can add as much as you want, but there's going to be a base premium, which is the insurance portion of it. And then there is the paid up addition, which is the overfunding amount that you can do. The government stepped in 1988 and put something called a modified endowment contract, right? And this allowed the government to kind of control how much people can overfund their policies. And so wealthy people would take a small policy and then funnel a ton of money in. And so they'd have access, they'd have control of their money, they'd have it growing, like they'd have all these benefits to their money in an insurance policy where nobody can see it or touch it. And then the government was like, whoa, like we can't allow this. Like we have no control over this. We can't see it. And so they put something called a MEC in, or a modified endowment contract. And what we're doing as Unbridled Wealth and as IBC is we're hugging that line. We're trying to get that policy as close to the line as possible without touching it. But yeah.
And Irene's asking, what's the downside? What if we cannot make the premium payments for the policy?
So, and I'll get into this a little bit later, where this is flexible, right? It's super flexible. Let's say the first year you had that $10,000 premium, right? And so you have the base of 2,000 and then the paid up addition of 8,000. If COVID happens and you can't pay that full 10,000, let's say, you can drop it right to the base premium and your policy will still be in force. Right. So you could go right to $2,000 instead of the $10,000. So that's one way, because that is flexible. And then the following year, let's say you have a great year investing, you can back pay your paid up addition. So you could be right back up to where you were when you left off. Another thing is, let's say you can't pay the $2,000, right? Just the base premium to keep the policy in force. You can use your cash value inside the policy to then pay for the premium to keep the policy in force. And so you could probably do that for a couple of years. Obviously, you don't want to do that forever, because then the policy will lapse if you're trying to use itself to fund itself. But in a hard time, in a year where something happens and you need funding, you have it there, you have it available, and it is flexible. But that's why we don't leave our patients out to dry as Unbridled. Like we come and we check in, we're constantly working with you and seeing where you're at, so that we can help make the best decision and make the best financial decision. You know, I think it's important to have people surrounding you, a CPA, you know, a financial guy, so that you can make the best financial decision that you can make.
Yeah, exactly. And Karine, I know you're asking what type of whole life policy allows these features. So that's really more, you know, when you do a consulting with Michael, because he is an expert on this, there are a lot of different options out there. So that's probably more of a one-on-one kind of question. And again, we did put Michael's information in the chat also. And then Irene's asking, is there a cap on the money into the policy? So I guess
Is there?
that goes to the MEC. If you're,
Yeah, it depends on the MEC. It depends on health and age. Well, it doesn't really depend on health and age per se, but it also depends on income. So if you're making good money, you're able to pour in a lot of money. Like they're not going to over leverage people, and so they're going to be checking in. There's different checks that you go through. There's health. Wow, totally mind blanking. But there's they come in and check your health, make sure everything is good, and then we kind of set it up based on your individual. It's not a one size fits all type of policy, and we'll get into that a little bit too. It's very individualized.
absolutely. And I think that's enough questions for now. Let's keep on going.
Yeah. So a big thing with real estate investors is financial independence. Why we kind of branch from our job, our jobs, right? Is because we want financial independence. We want to have these doors to kind of provide for our family, to have long-term gains, to have wealth, to be able to help people in foreclosures or pre-foreclosures, right? There's a ton of different ways that we want to become financially independent. And that's a huge one for real estate investors. So we're going to look at a case study real quick on this guy, Jim. Jim is a 40-year-old married man with 2 kids. I can relate with the 2 kids. I'm almost to the 40. I'm not going to say that yet. And so, but the 2 kids I can relate to. Combined, he's making about 120K per year. He's netting about 90K of that per year and has 4 rental properties, each netting about 500 per month. So he's already in the rental industry. He's already doing really well. Like his numbers look good. Jim hears about IBC and asks the question, what I am doing is currently working. Why would I want to invest in IBC? And I kind of touched on this a little bit, but IBC is not the investment. This is the and asset, right? This should come and help accelerate your investments. This should come and be an asset to your assets. And so if we're looking at this as a comparison, apples to apples comparison, we would want to compare it to like a Fells Wargo account to IBC account. I don't know who banks here with Fells Wargo, but I'm sure somebody does. So in the same way you would take your Fells account and you would go and put a down payment on a property or buy a rental property, right, with cash, let's say, you would do the same with your IBC policy. So you would borrow against your policy and buy a rental property, put a down payment on a property, but you wouldn't just leave your Wells Fargo or Fells Fargo account at zero, right? You would want to refund your bank account so that you have money for your next purchase, right? And so you would take rental income, a cash out refi, right? Do the BRRRR strategy, whatever it may be, and refund your Wells Fargo account so that there's money in it. In the same way you would refund your IBC policy and put the money back into that account. And so it's acting as this banking tool. And so we want to look at it as a bank. And so Jim hears that and he says, wow, well, what's the next step? How much do I put towards it, right? Like, how can I buy this thing? And that's not really the best way to look at it because it's very individualized. It's not a cookie cutter strategy. It's not a one size fits all, right? We would do a financial review. We want to get to know Jim's goals. We want to see where you're headed, long-term, short-term, midterm goals, and see if we can get to those goals faster, more quickly, or more effectively and have a better outcome, right? And so Jim came to us. He gave us goal number 1, obtain a few more rental properties. Goal number 2, we have a retirement where I would not have to change the way he lives. So he wants to have a retirement and he wants to have some more rental properties. So what he needs is liquidity, right? He needs liquidity for his rental properties. And then he needs something as along the lines of its supplemental retirement, right? So we have a 30,000 feet view here of a financial review that we go through. And this is only 2 small portions of it. It's a couple pages long. But from this information, we're going to put together a plan for Jim. And what we see is free cash flow here. We see total income, property income, taxes, expenses, and then we see total free cash flow in black. We see he's cash flowing $44,000 a year, which is really good. You know, he's doing phenomenal. Liquidity, he's got in his bank accounts $40,000 saved for his next rental. And so what we're going to do is we're going to say, Jim, we have a strategy that might be of benefit to you, right? Take a look at the policy that we created. And so we create this policy, and what we see is this first year, he's got $50,000 outlay that first year. And if we're looking at this as a bank, that's what we really want to see, right? Not that you're buying $50,000 of insurance, but that you're using this for investments here. So $50,000, how we got that was from 30,000 of cash flow. So he still has 14 of cash flow, and then 20,000 of liquidity, right? So he still has 20,000 in his bank accounts ready to use. What we put together then is the cash value grew that first year, and he has access to 41,295. So he lost access to about 8,500, right? But that 8,500 bought him a death benefit that's going to live on. And then it also started to implement this bank, right? And so that's going to continue to grow. Now that second year, we see $30,000 outlay. So that just comes out of that free cash flow. We don't touch the liquidity at all anymore. And we say, if you take 30,000 of what's coming in and put it towards your savings pool here, he would have 70,000 that next year. Now, he grew by that $30,000. So he's at 40 and he jumped to 70. I wanted to show you guys today a realistic example. This is a very middle of the road health rating. And so this isn't the best health rating. Jim isn't the healthiest guy. And so I wanted to make sure, like, he's a 40-year-old guy that's average health rating. There's a couple other health ratings that are a lot better. And so the policy could even look better than this. And so that second year, that whole 30,000 goes in that he has access to, which means that the gains inside the policy are more than the premium cost that he's putting in, right? It's starting to cash flow is what we want. And so we go down, let's say to year 10, we see he put in 320, he has about 350. We also see in year 11 that it drops to the base premium now. So his base is 6,975, and he's cash flowing the rest of that back in his pocket. Now, his first goal was to obtain a few more rental properties. Jim can take that $90,000 and get a rental property in year 3 if he wanted to. He can access this money in year 1 and 2 if he wanted to as well. But I'm just going to look at year 3. He can take 90,000, 95,000 and go purchase a rental property and start cash flowing even more, right? He could then pay that back in the next 5 years. Let's say COVID happens, a recession happens, and properties are going for super cheap. In year 8, he has $268,000 liquid that he can utilize and have access to, no questions asked. No matter the type of market where people aren't giving mortgages, where people aren't giving HELOCs and taking out, he can go and grab this money and go and buy some rental properties or fix and flips or whatever in the cheap market. And then on top of that, let's say he buys 2 with that 268,000, and let's say he only wants to pay interest for the next 2 years, right? Because he just wants to start cash flowing there. He can pay interest for the next 2 years. And then year 11, he gets all this cash flow, about $24,000 back in cash flow that he was putting into the policy, that now he can start paying back his loan in there. So he pays interest, which is 3.5% for those next 2 years, and then he can start paying it back in year 11, right? So it's super, super flexible. Now we see goal number 2. So goal number 2 is have a retirement. And so as this policy continues, his cash value is growing, his death benefits growing. And so let's say Jim wants to retire in year 70. Jim has $1 million in tax-free retirement income that he could start pulling from. He could take $55,000 a year for the rest of his life. He can take some money out and supplement maybe his 401k, his Roth IRA. If the market's not doing great, he can pull more from this than his other investments. He also has rental properties that he's been pouring into. So not only did this help him purchase rental properties along the way, but now it's acting as a supplemental retirement income. What I want to show you real fast is $487,000 is what he put in, which sounds like a good amount, right? But he has $1 million in tax-free income that he can pull out now. And then he also has a $1.7 million in death benefit. And so I'm going to touch a little bit on that portion of it, which is retirement. And so when we see policy value in retirement years, this is super important, especially as an investor. We're not really getting a 401k. You might have one already, but we're not pouring into these vehicles as much because you want that liquidity, right? And so this acts as both your liquidity vehicle and a supplemental retirement vehicle. And this was done on a 35-year-old in pretty good health. There's still another health rating above that he could get. And he poured in for 30, this is the end of 36 years. So he was 35 years old. He put in 500,000 in this red box over the course of that time. He's able to take 65,000 tax-free for 20 years up until 90. And so he took out $1.3 million in retirement income. And tax-free retirement income is a lot different than taxable retirement income. I'm sure Anish could add value to that too.
Yeah, I mean, so the funny part is, right, like, again, you're still getting the death benefit, right? It's still growing, number one. And this is part of why it's called infinite banking, is that you're getting the death benefit, you're getting the tax savings, right? So the IRS, it's a loan. So you're not worried about, according to the IRS, on loans, you don't pay any taxes.
Correct.
So that's why we're not worried about the IRS. Not going to be political, but we've seen what's been happening, right? Generally speaking, I always ask people, doesn't matter what side you're on, what do you think is going to happen with taxes?
Yeah.
And
do you think it's going to go up or down?
Yeah, more often than not, you feel like it's up. And what you're doing is you're leveraging yourself and hedging this. And traditional educators don't teach this. What I really like about, Michael, and, he talks about his clients and he's doing it, I'm doing it, is smarter people than us, wealthier people than us have been doing it for a long time. So, not to be able to tap into this is a big difference. And again, like he's showing, like, these are not wealthy people. This is like a normal average investor, maybe I would say, like in our market. Like I know a lot of people in this that are in this space. And again, you could start as, as little as, I think you were mentioning, you could do it as little as maybe $200 a month.
Yeah, for sure.
To kind of get started. At least you're in the game on that portion. So I think it's just, when you start looking at the big picture, it's like, aha, right? We kind of joke about it here at Bria. You always hear me, you've probably heard me say in webinars, your first job is to make money. The second is to keep it legally. And when I say legally, least amount of taxes. So
no, and it's so true. And so with this example right here, we see that they put in 500,000. They spent $1.3 million in retirement. And then let's say they passed away at 90 years old, they left $1 million. So the policy was able to pay out $2.3 million in tax-free retirement income in a way, or tax-free, not 2.3 retirement income, but the policy paid out $2.3 million out of $500,000 that poured in. And so I think there is huge value. And if he lived past 90, he still has $570,000 to continue pulling from for his retirement vehicle.
Yep.
So
and again, so besides his rental properties that he owns, right? So hopefully he's still cash flowing on that. Let's just assume on that. Maybe, we'll talk about maybe if there's Social Security or whatever that amount is. Maybe you put some in your traditional IRA. So this is just an add-on, God forbid, long-term care, there's a lot of different things that can happen. So this will, I know some of the things that benefits how it could be used for long-term care too. So.
Yeah, definitely. Yeah. And so kind of the problems that investors face right now is the lack of control and liquidity, right? This is huge for investors because where do you store your money? Where are you keeping it? And how is it growing? How do you get it out? And then lack of flexibility, right? There's always terms and things in which you need to jump over, loopholes you need to take, right? Taxes are another big one, right? Taxes, we're all paying capital gains tax. We getting taxed up the wazoo. Anish just said, are taxes going up or down, right? And everybody will probably say taxes are going to go up in the future, especially with how much debt we're getting in, right? Financing, we finance everything we buy, right? We're financing the houses and so this is an optimal way to finance things. And then opportunity cost. What are you putting your money in that you might be missing out on something else, right? And deal flow. I think with properties and with real estate, sometimes there's deal flow and sometimes there's not. So sometimes there's deals that you're purchasing, and right now it's kind of a tough market. It's such a high market that maybe you don't want to invest all your money. Maybe you want to be saving right now, which means that you're not making money with your money. But if your money was in a place where it's going to grow consistently, now all of a sudden you're not super worried about deal flow. You know that your money is going to be working for you long term, and then you have access to it when needed, right? And so how do we solve these? Through IBC, through one of these strategies. The strategy that I've mentioned today is a phenomenal one that could really benefit investors. And so why whole life? And this is kind of the question. Guaranteed long-term returns, right? We don't want something that's not guaranteed. We don't want something that is going to be hit or miss, right? When you're putting your money in to invest in certain things. And then plus dividends. And the mutual carriers that we use have been paying dividends for 130 plus years. And so are they guaranteed? No. But have they been paying out for 130 years? Yes. And so that's super important.
And actually the second part of that, when you say guaranteed, like what happens, like truly clarify that, let's say the stock market, right, takes a major dump, right? It goes down 50%.
Yep.
Is my policy or my money going to go down? I know the answer, but if you could elaborate what that really.
Yeah, no. So if the stock market drops, insurance companies and proper insurance companies that are mutual carriers don't have their money invested in the market. They have portions of it, small portions of it, so that they could get good gains in certain areas, but majority are in safe assets that are growing, whether that's government bonds, certain things that are going to grow, commercial real estate, big commercial real estate that we can't really purchase on our own, right? Certain things that are going to grow long term and keep their assets building. It's not going to fluctuate with market value. This is a contractual guarantee, just like a mortgage payment you have, or a mortgage, you have a 3.5% mortgage, right? This is a 4% guaranteed long-term return. So it's there. It's not fluctuating up and down.
And I'm going to even, share my own experience because I was with another person that originally had my life insurance, and it was a variable policy. And so when the market went down, like I'm actually down versus all the premiums I put into it, and it's been 8 years.
Yeah.
Like I was super upset that, hey, the market went down, like my policy, my cash value went down. And then the second end of it, other lenders, they wouldn't lend on it because it was variable. So my money was really tied up. So
Yes.
that's the example I want to use about not having the right person do your insurance or the policy. It's not one fits all. Again, like I'm living proof of not having the knowledge. So.
Yeah, and I think it's huge importance. There's some policies out there, and there's some certain vehicles out there that take the place of this and try and do what this does. But the problem is they are not tested and time tested. And so what you get is this fluctuation in cash values. You get the inability to lend against or loan against, right? And so it's tough. And we've seen that in a lot of people. And we kind of have a lot of our clients say, hey, I already have this policy. Like, what can I do? Well, you can transfer it to a policy that we have. I mean, obviously you lose some of the premiums, you have to lose some, there's some negatives to that, but if it was going in a downtrend, you'd rather something be positive than negative. And so there are a lot of vehicles. And if you have a vehicle that you're utilizing and you're not loving what it's doing or where it's going, reach out and we can set something up and kind of look over it and see if we can create something that's a little bit better, create something that's long-term and guaranteed that you have that growth.
Absolutely.
Yeah. And so tax-free retirement income was something else that, like we said, it's supplemented. You could supplement 401k. You could supplement something that's in the market that might not be doing as good right now. And this could be a huge asset to that. And then liquidity and control, right? You have control of the terms, you have it liquid, you're able to borrow against it when you need it. Optimally financing and unstructured policy loans, kind of the same deal, where you structure the loan, you set up how you want to pay it, when you want to pay it, and then it's just optimally financed because it's your money. Tax-free death benefit to your beneficiaries, your company. If you have a company, right, and you want the longevity of the company, I'll get into it in a little bit, how our company, Unbridled Wealth, utilizes this to bank on their mortgage, right? And that's huge. And the company is going to live on for a long time because of the policy that they created. Anish mentioned long-term care. This has a form of long-term care built in, where you can take care of yourself if that's the case. If you get terminally ill, if certain things happen, right, you're able to utilize the death benefit, and they will provide the death benefit to help you out there ahead of time. And then creditor protection, which I think is huge too. People can't come after your money, and this is in most states. In Florida, it is that way. Some states don't have that, but creditor protection is huge. People coming after you, they can't see that this is an asset to you. Applications of this, right? Savings or emergency funds, real estate and investment funds, right? You can create a positive arbitrage with your money, right? Where your money's growing inside the policy, it's growing inside an investment. I mean, you're literally capitalizing on interest all over the place. And so that's an amazing tool.
And I'm just gonna, I'm gonna even give you my own example. So, excuse me, like I have my own policy. Michael's, also they teamed up with, there's several banks out there that'll give you 95% of whatever your cash policy is. You're just pledging it, and they have no closing cost. My rate's 3.5%. So on my dividend last year, well, I'm curious to see what I'll get. Again, it's not guaranteed, but it was 12% last year. I was paying 3.5% on the money, and then I lent out the money at 12%. So I made another 8.5%, and then I charged points. So I was kind of doing the math a little bit for doing really nothing different except, using some of these techniques. I almost made about 25% on my money. And that's what insurance arbitrage really is. So once you kind of do this, it's weird until it happens. And then I wasn't sure. I was like, I don't know if Michael's, is it really right? Does this really happen? And you just start taking the steps. So now I'm excited to see, how you could keep, arbitraging, right? You're like, this is what banks do. This is what, big money does on that portion. Yep. So think about how hard you work. And, again, nothing's guaranteed. So I have to always keep that out on that. But, and I know Michael lends money, and I know you use these kind of tools also on the arbitrage. So,
yeah, definitely. And I mean, it's unreal what it can do to increase your rate of return, your RRR, right? And increase interest all around. So fantastic tool. This could also be used for education, right? We saw kind of in Jim's case back in that case study, like he could use this money to pay for his children's education as they get older, right? He has 2 kids. He can also use this as a debt repayment. If you have student loan debts, right? I have awesome strategies that funnel the student loan debt and the cash flow through a policy, which then you're able to pay off the student loan debt, have something working for you, and have this tool at the end of it all. And so you could either pay that off faster or, and then have your money actually working for you. Retirement income supplement, like we said earlier. So where are you in your real estate journey, right? Are you saving for your next big property? Are you waiting for the next big downturn, which a lot of us are? It has never been a better time to start utilizing this strategy. Most people, they say, after learning this and after engaging this, I wish I learned this 10 years ago, right? And many of the wealthiest individuals in the world utilize this compounding tool behind their investments, their businesses, right? Their everyday life. So if you're ready to become and work with the Generous Banker, take out your phones right now. And and if you want to know more, reach out to me. But you could even do this for real quick. Take out your phones and take a picture right here of a QR code that I set up. This will send you right to my page. I also have on here my email address, phone number, and then I set up a special link for unbridledwealth.berea. And so it'll take you right to our page, and then you can sign up right on my Calendly. I'd love to take a 30-minute consultation, get to know you. I'm a local here. We could even go grab some coffee, maybe, whatever it may be. And, take some time to really learn your real estate journey, what to have ready. If you want to have some short-term, long-term goals, maybe some questions for me about this stuff, I'm more than willing to answer questions, sit down and really see if this strategy could benefit you.
And also, since I'm actually doing this too, obviously Michael's the expert. You guys have my email too, and you could ask me.
Yep.
Brian and I are very transparent. I was really excited when I spoke to Michael a while back and him becoming a corporate member. Even on this webinar, I'm like learning some stuff that I am not using fully. And so it's been it's an interesting journey all the way through, and don't feel like you don't have much. As we mentioned, you could probably get started with as little as $200 a month. Talk to Michael on that portion. We do have some more questions, Michael, so you can leave that screen up a little bit. So Daniel's asking, isn't there a fee to borrow from the cash policy?
No, there's no fees to borrow from the cash policy. This is your money, and so the insurance carrier wires it right to your account, or if it's through Ameris Bank, like Anish was saying, you can write a check right there, and so it's yours to use, and so there's no fees.
Absolutely. And Irene's asking, if you get a policy on a child, that policy will guarantee insurability and be a long-term funding opportunity and retirement for the child. So they want to make sure, people are using that for their kids also. I think Irene's also, if I'm correct, I think she's an insurance person, or she's nice. She knows it pretty well. So
what was that?
I was saying, I'm sorry, you do have people that are getting policies for children.
Yeah, juvenile policies. Yeah. And so I'm going to be taking one out on my children soon. And so what this is, juvenile policies, you can't fund it as much. And so they're not going to give you, because there's no health rating on them, because they're insurable, and they're not going to do a health test on them and make sure everything checks out. You can fund them and overfund them by about, I think you could get a 40-60. So you could do 40% base, 60% paid up addition, and that's going to do the same exact thing. It's just, and then you can hand over that policy when they're 18 years old, and they can either utilize that for college, they can utilize that for, like you said, retirement, and the death benefit is linked to them. And so their kids get a death benefit. They could take that and then transfer the cash value into another policy later on in life. So there's a lot of things that you can do with them. Yeah, but we see a lot of people take out on their kids when they see the value of this.
Absolutely. And they're asking, what's the interest rate on the loan? So
the loan, so the loan interest rate for our private lender, so the CV lock, cash value line of credit with Ameris Bank, right now we're getting a 3.5% interest rate. And then if you go direct from the carrier, it's a 5% interest rate, which is locked in. And so you can, Ameris Bank in 5 years, if they're like, hey, we need to up the loan amount, and they up it to 6, you can go right from the carrier and get it from 5%. So that won't fluctuate.
Yeah, and I actually use them. So they've already upped, as I've been overfunding the policy. They literally, they contact Michael and his team. They'll just pledge the policies that you have and give them the new value. And it was like simple loan documents. I don't know. It's like a 3-pager or 4-pager, and they instantly, same account number, same checks, all that other good stuff, and they just increase my policy.
Oh yeah, increasing it for Ameris. Yep.
Daniel's asking, what happens to the cash value when I pass?
The cash value. So the cash value is, if you think of it as equity that you're able to utilize, that you don't get when you sell a property, right? And this is kind of the best way that I can explain it, I guess, is when you sell a property, you would get the whole amount of that property, right? So you'd get, if it's 300,000, you'd get 300,000. If
Yep.
you pass away, your death benefit is what the equity is. And so your death benefit being 300,000, that's what your family gets. What the insurance company is allowing you to access is the HELOC inside of that. So it's a line of credit that's accredited from that death benefit. And so you don't get both the HELOC and the value of the house when you sell the property. You only get the property. And so the death benefit is what your beneficiary will receive, the cash value. You don't receive that because that's what you're able to borrow from the policy, from what they owe you.
Absolutely. And the other thing, like even Ryan and I use this. So part of the reason we even got our policies, we have a buy sell policy. So if you have partners, right, in your business, and as you're starting to grow your company, it's going to be worth something. If something happens to your partner, do you want to be in business with them, right? So I don't think Ryan wants to be in business with my wife if something happens to me, right? So you could use the policies as a win-win. So
Correct.
like you mentioned that, it could be someone that usually you definitely want to have that relationship for whatever reason that you're doing it. But I know
you have to have some insurable interest. Yeah.
Correct. So I know that you've probably seen that where, what happens, you own a properties in your LLC and you have two other partners.
Yep.
Or something of that nature. Have you're working with higher net worth people, or maybe you only have two properties. I mean, is that some of the strategies that you're seeing with some investors?
Yeah, 100%. We work with a lot of businesses with multiple owners and people that want to hedge against, all of a sudden they lose 50% of their business because the other owner dies, right? That's going to go right to the husband, the wife, or the husband or wife, and they don't want to be partners, right? Because they can kind of do what they want with the company, especially if it's like a 52-48% ownership stake, where you want to make sure, hey, I want the opportunity to buy out that portion of the company so that I can make sure that this company is going in the direction that we want it to go. So definitely, that's a huge plus. So thank you for bringing that up.
Yep, absolutely. And so we're near the end of Michael's presentation. So we put his contact information in the chat. Yep. It's on our website, all the other good stuff. But we do have some winners. So I want to, Alexa, if you want to throw some names out of who won. And by the way, everyone's a winner, meaning you could always contact Michael. He's not only going to provide information for the winners.
Yeah.
Yeah, so Alexa, new Alexa, everyone meet Alexa Marie.
Hi everyone, nice to meet you.
She's awesome. She'll let us know who is winning today. Go ahead, Alexa.
All right, drum roll please. This is awesome because we have 7 winners today. So Michael has hand selected some books that's helped him learn, and some books that he will help you guys absorb all of this information that he's been talking about. So the first winners who won books are going to be Iris Lopez, Irene Randall, Joseph Asif, Olga, I don't think we have her last name, we'll find out, and Douglas Paul. So congratulations, you guys. We'll get in contact with you and we're gonna send you over those books. Now for the big grand prize winner, the people who are getting a one-on-one consult with Michael for 1 hour. This usually costs around $100 to $200. You're going to get it for free. Are going to be Daniela Peer and Daniel G. Congratulations, guys.
Congrats.
Awesome.
All right,
Yep,
so we're going to put all of this in the chat, and just in case you missed your name, we'll put exactly this information in, and we'll get in contact with you.
Yeah, or to make it even easier, if you contact our office, make them do some of the work.
Right.
Contact our office to get.
Here, I'll put the number in the chat.
Yeah, go for it. Awesome.
For sure.
Thanks,
Got to be
Michael.
some reciprocal.
All I know is Michael, I mean, all these other corporate partners. Now I'm going to throw it in and be like, hey, Michael gave away way more stuff than you did.
Yeah, come on. I mean, they're slacking over here.
Absolutely. And so Michael, as you know, we're excited again, having you on today. The replays, by the way, guys, if you're not signed up for our YouTube channel, this will be up in 48 hours. So, make sure you subscribe. If you miss any of these webinars, it's a ton of information. So I know for new people, the first time I heard this kind of stuff, it's like replay after replay. So he said, what did they say? I'm so confused, all the above. That's normal. So don't beat yourself up. Watch the replay. Make sure you actually, book an appointment for a free consultation for 30 minutes. Usually Michael doesn't do any of this, but Ryan and I here at Bria, we push our corporate partners to give something to our group, especially our members. We want to make this a win-win for everyone. And Michael, is there any last little advice or anything that you want to really share?
It's a ton of information. And so I appreciate you guys sticking on for the whole time. I know that there's 47 people still on here, which is phenomenal. I mean, that's amazing. And so I'm excited to get to know you guys. I'm a local once again. And even if you might have somebody that you're working with, like, I'd love to just get to know you with a free consultation, a 30-minute get to know you. And so please sign up. And yeah, I'd love to meet you.
Yeah. And the other thing is, Michael could have done a full 8 hours today. So we just touched on a couple things today.
Yeah.
So it doesn't matter where you're at. You might be doing some of the things that I'm already doing, right? And even I need to meet with Michael and say, hey, what am I missing? So it doesn't matter what level you're in. And if it's not for you, it might be for a family member, right? I mean, there's a lot of things out there. The pandemic, right? If anything for everyone, it's probably a reset button.
Yeah.
So, I really started working on my own personal stuff. I hate to say when the pandemic really started, I was quote unquote too busy doing other things. And you got to really take care of yourself first. I'm saying your health, your financial picture, your family's financial picture, and one little thing might change the difference, right? I know you're using that example of the guy buying the 4 houses versus, the net worth, just a couple little changes that you actually, do, right? So it's not about just educating. Ryan and I, you'll always constantly hear us like, be in motion,
right?
And what's stopping you, and it shouldn't be education anymore.
Yeah.
Right. So that's,
there's always something to learn. And I think, even the owner of Unbridled companies, he owns 22 companies, and he utilizes these strategies for all 22 companies, and all the mortgages that they own, they float the mortgages through policies. And so there's some really big things that you can do with this. When you think outside the box, you look at the tax advantages and all that. And so we saw kind of a 30,000 feet view of a big investment strategy, or a strategy for wealth long-term. Yeah.
And the last thing I'll lead you with is lead everyone is with, if you don't have money for your deals, guess what? This is the easiest way to raise money for your deals, right? Maybe you're not in that spot where you could overfund, or, you're just starting out. There may be someone in your network that might be able to do this. Hey, you're going to show them all this other stuff, and maybe they'll fund your deals too. So just a little tidbit, of what's possible out there. So.
Yeah, you could definitely, I mean, private money lending through this is a phenomenal way to have positive arbitrage. And so if you know somebody that can, I'm sure they'll lend you a deal, or lend you and give you a good interest rate too.
Yeah, absolutely. Right. Absolutely. So, hey, Michael, thank you so much for spending the afternoon with us, educating our viewers, including me. Thanks for the great giveaways, and hopefully we'll have you back on. If you need Michael's information, it's in the chat, or if you go to bria.com, he's one of our corporate partners. Give him a call. He's a smart guy. He's a real estate investor, and he's got a lot of strategies out there that we're all using. So thank you, Michael.
Thank you, guys. Appreciate it. Bye, everybody.
Bye. Take care, guys.
Great day, everyone. Thank you.